before we start, I mean, everyone knows who you are, Mike. You've been presenting all this time, but give us a quick intro into who you are for anyone that's joining now. Same thing with everyone else. And then I think what would be helpful is if you guys told us, each gave us a sense of your views on your overall framework on markets and your macro framework.
Sure. So Mike Green, Simplify Asset Management. I'm the chief strategist and a portfolio manager for many of our products, and have been the host here today as we've held this event for the charitable group, Coney Island Prep. Really thrilled to have you host this, Demetri. I believe that you've interviewed all of us, at least individually, on other spaces or a different format.
Yeah, except for Mike, but Mike and I have had a chance to talk, so.
Okay. Mike?
Okay. Another Mike. Michael Kantrowitz. I'm the chief investment strategist at Piper Sandler. I've been in the industry almost 20 years. Came from Cornerstone Macro, which Piper Sandler acquired back in February. Before that, Wolf Research and ISI Group and Merrill Lynch Research, back in the housing bubble days. And I guess we'll go to the market commentary after, but yeah, pass it to Jim.
Yeah, I'm Jim Bianco. I'm the president and founder of Bianco Research, located in Chicago, macro research firm that's affiliated with a bond brokerage firm called Arbor Research and Trading.
And so you'd asked a question about in terms of the framework. I mean, I think it's part of the reason why I put the panel together in the way that that we did, is that we all bring slightly different components to it, right? So I tend to focus in macro on the dynamics of what are the constraints in the system, right? I'm always looking for why is something going to be forced? Why is something going to be different, tied either to market structure or to policy choices, et cetera? Mike I brought in because he's one of the best quant thinkers that I know. He's really worked on the framework around business cycles. And Jim is one of the smartest guys in rates that I've ever met. So I'll let them add to those individual components.
Sure. So yeah, our framework around the market, and so we're doing everything from obviously putting a year-end target out there, but really the bread and butter of what we do is positioning the portfolio for where we see the macro and market environment over the next 6, 12, 18 months. And so we use various leading indicators that have worked across history, across regimes. So ironically, as a base case, we look for the parts of the cycle that are repeated in every cycle, and have kind of come up with a very simple acronym for the way the business cycle works, which is HOPE, which stands for housing, orders, profits, employment. And that's pretty much the oversimplified way of how the US business cycle improves and deteriorates across time, throughout all of time. So we're always looking for where momentum is going, and we came into this year with a pretty bearish outlook, and it's only gotten more bearish as the problems have only gotten larger and have hung around longer. So I was gonna think, Mike, did you put this panel together because we're all so bullish?
Yeah, exactly.
I think so. But we integrate, again, a lot of historical data on market cycles. And we also do quantitative research. So we take the investment conclusions from the top down, getting all the way down to what are the best longs and shorts on a stock level, industry level, ETF level for our institutional clients.
So I tend to look at the market from a secular basis or a narrative basis, and what I've been arguing is that the pandemic has essentially taken trends that were in place and have sped them up. So, I'm a big fan of sci-fi movies and I like time travel movies, so welcome to the year 2045. We got there really fast, and now the economy needs to kind of adjust to the whole movement of the era of maybe cheap labor is now being questioned. I thought Jim Chanos made a very good argument for that in the panel before. Cheap goods, with the problems that we're having with China and in a just-in-time inventory world, that's going to be a very big problem. And cheap energy, especially for Europe, that is going to result in higher levels of inflation, more economic volatility. And I think what you've seen in markets this year is that adjustment towards that reality. And that adjustment towards that reality is going to continue for a while longer until everybody starts to change into that new reality. A good example of that is the one that we're all talking about today, is liability-driven investing out of the UK pensions. That was all predicated on the idea that we were in an era of low inflation, little volatility, very low rates, so that investment thesis made sense. We're not in that period anymore, and that's why it's having such a difficult time. And I think we're going to see more of that as we move forward.
So you guys raised a bunch of things that I actually want to tackle, both cyclically where we are in the cycle, Mike, and also this thing about the post-pandemic economy and structural inflation, and are we in a new paradigm now? Before we do that, I'm actually curious to ask all of you a question about investor frameworks, because pre-2022, it seems that the dominant framework, at least roughly speaking from Mario Draghi's speech in 2012 to 2022, was the Fed's got your back. The Fed's your friend. If markets drop too far too fast, if there's too much blood in the water, the Fed can't stand the sight of blood in the water, and it's going to come in and it's going to support the market. It seems that, I think that was broadly a consensus view. It seems that in 2022, there is an emergent view that is gaining traction. I don't know how widely held it is, and that's one of the questions I'm curious about. But the view is roughly that the Fed actually, not only does it not particularly care about equity markets, but absent a meaningful reduction or a trend reduction in realized inflation, the Fed wants equity markets down. And whenever equity markets get a little bit of a pep in their step, you start seeing stories coming out of the Wall Street Journal, CNBC, et cetera, saying, FOMC members aren't really happy about that. Somewhere in some boardroom somewhere, Jay Powell is steaming, plotting his next rate hike. So is that, one, do you agree with that framing, that there's been a noticeable, meaningful shift? How widespread is it? And how credible is that paradigm for thinking about Fed policy when higher rates mean higher cost of capital for the government, and in an economy that relies so much on debt refinancing, there's only so much in terms of balance sheet reduction that they can take?
Want me to start?
Yeah, please.
Okay. I do agree that there has been a paradigm shift from the Fed, that they are no longer your friend anymore. Or you know what? You could take all central banks. I mean, Mario Draghi, whatever it takes in 2012. And what has changed is inflation. And what is really pushing them is this idea of inflation. Jay Powell has said it himself. 40% of the public has less than $1,000 of savings and they rent. They don't own financial assets. They don't own real estate. So when prices are outstripping their wage gains, they just lose. The rest of us, we're losing this year, but Case-Shiller was up 18% last year. The S&P was up 29% last year. And for a while there, we all thought that inflation's not a bad thing, because what we're seeing in our assets that we own is appreciating faster than the inflation rate. Well, that's all reversed real quick. So what Powell has been pushing is this idea that the Fed needs to respond to inflation and needs to respond to inflation hard and aggressively. And the marketplace has had a very difficult time coming to grips with that. That's why we have this constant talk about a Fed pivot. And and I've joked around that the Fed pivot is, please make my portfolio go up. That's really all it is at this point. It is nothing short of that. So I do think that has been, yes, the Fed has definitely turned, and it is a very difficult thing for people to come to grips with.
Yeah, and I'd echo everything Jim said, and I totally agree. And I think Powell's trying to rebuild Fed credibility that kind of went to zero in 2018 and 2019. While Mike and Jim were talking, I was thinking about, and I actually looked up a chart on my laptop. How many times has the Fed cut rates in history when claims were not going up and when the unemployment backdrop was not deteriorating? It's happened 3 times. One was 1987, crisis, crash. Second time was 1998, crisis, crash. And the third time was 2018. Where was the crisis there? Where was unemployment going up? Claims certainly weren't rising. Yet, they totally cut rates pretty massively and started this huge liquidity train. So I think, in that context, we've got a long way to go, and the bar for the Fed changing course from a unintended consequence of rate hikes or further deterioration in the economy, particularly the labor market, is very far away. It's a very high bar. Yet, we see the markets. I mean, the minutes today had the same statement that Powell said months ago. At some point, we will slow down the pace. And the market's popped on that. And it's just like, come on, people, when are we going to learn?
Well, so I actually am probably more in the pivot camp and saying, please make my portfolio go up, except that has nothing to do with the rationale for why I think that. I'm actually very concerned and would direct people to like where we're actually looking at things in the world, right? Europe has been devastated and is increasingly incapable of productive capability. Japan has been devastated by the increase in interest rates and energy costs and is increasingly incapable of solving problems. An encroaching, communist threat is threatening areas of production around the world, and we're forced to deal with these dynamics. We are looking at what feels like a totally unprecedented environment, except that was 1945. Right? And in 1945, inflation, as we changed the structure, we reopened the US economy, consumption for the consumer sector began to dominate over production in the military sector. We converted factories back over from producing tanks to producing automobiles. We had a massive shift in the consumption basket. We saw inflation rise by 20% and then retreat. And the Fed did absolutely nothing in that entire process. It was allowed to proceed. What we're seeing this time around is volatility injected into the system by the Fed feeling that it has to respond. I actually think part of the problem that we're experiencing is that we've become trapped by the Milton Friedman quote of inflation is always and everywhere a monetary phenomenon, and yet it almost has nothing to do with what we're experiencing. We're making it become part of the experience by reacting in the manner that we're doing, and I would argue that we're doing that largely for political reasons. But this, to me, is terrifying. We're injecting volatility, as I alluded to in my conversation with Jim Chanos earlier today. My partner, Harley Bassman, who created the MOVE index, the interest rate volatility index, looks at it and says, this isn't possible. This can't be occurring. And yet it is. Why we're choosing to do that is completely beyond me.
So Mike K mentioned 3 dates. You mentioned 87, 98. So 87 was the 87 crash, 98 was the Asian financial crisis, and then what was it?
LTCM, and then the pivot in 2018.
2018.
Yeah, the economy was slowing, but there's no signs of labor market deterioration.
Right, but in that period, there was some financial instability in markets, if I remember correctly.
Yeah,
that was the whole repo thing,
think,
right? That was the whole repo tantrum.
Was that a crisis that was brewing? Did that warrant?
That came September 2019. I think it was more the Fed was going to reduce its balance sheet and it was on automatic pilot, and the market freaked out.
But that was why they paused.
Right.
Why they cut though.
Mm-hmm. Right. So but all right. So in all three of these cases, the concern was driven by financial markets, right? The Fed pivot was driven by financial market concerns. But in all three of those periods, something that they have in common is that inflation was either low or it was
effectively zero.
It was exactly, or it was declining, right? Like it was in '87. So in all of those cases, that we have the NYC bell. So in all those cases, the Fed was not caught in this trap between trying to manage this unofficial mandate of financial stability and inflation. Now it is. And the question is, if something, quote, breaks, this is a common concern. We can talk about what that even means for something to break. But if something were to, quote, break, or if something in financial market plumbing would lead to a lot of volatility, et cetera, and people would want the Fed to intervene to do something, how does the Fed manage that? What does that look like? What does a Fed pivot look like in such a scenario where inflation remains high? Can they do that and maintain the kind of credibility that I know Mike Green doesn't even think is relevant in this equation? Like, how do you guys think about that?
Yeah, I'll go first. If there is going to be a pivot, I think it's going to be a scenario where the Fed's first reaction could be, okay, the inflation problem is now over. We've now broken the economy to the point where we've broken inflation. So we no longer have to deal with this inflation problem. So now we can pivot, to use their word, to dealing with a financial crisis problem. And then they could kind of dust off the 2008 or 2018 playbook and start running whatever chapters in that playbook they need to run at that point. But understand what I just said. You got to break something to break inflation. British pensions are not breaking inflation. 25% down in the stock market is not breaking inflation. At least the Fed doesn't think that. So whatever it is going to be of such a magnitude that when the Fed does pivot, it's not going to help if you're waiting for your portfolio to go up. I know that everybody wants it to be some exogenous event that has nothing to do with me, British pensions. And then therefore now Jay can stop and the market can go up. But I do think it will have to be something where you could immediately say, now the inflation problem's behind us because we just broke the economy, which broke inflation.
Feel free, or I can ask more questions. I got plenty of them.
I lost track of the original question. It was a great response. But
the original question, I think, was what does a Fed pivot look like in an environment where financial instability is causing them to intervene, but realized inflation persists?
Yeah. So again, kind of going back to my original comments, we look for consistency across history, and there's really two sequences when the Fed pivots across history, right? Number one, you're either going to a recession or you're not. We've got the conditions today that are not similar to the 4 times the Fed hiked where you didn't go into recession, such as a huge broad-based inflation spike, banks that are tightening lending standards. That wasn't actually at all an issue that we saw in 2016, 17, or 18. Again, food and energy inflation was maybe 4%. And we got up to 22 in this cycle. So that kind of leads us to believe that the odds of going into recession are extremely high. And not to mention the Fed still hiking 21 months after the ISM New Orders Index has peaked, the 3rd longest period in history where rates are still going up. So I think ultimately Powell's trying to crush earnings because that's how you're going to get to the labor part of the story. And the bulk of this market decline has all been about, yes, higher rates, but at lower multiples. So I agree with Jim. I don't think the Fed cares at all about this negative wealth effect so far. That's really only touched equities. What's scary, and to Mike's point about, what has the Fed done? We don't know. We're not going to know for another year.
Right. So that was actually going to be a follow-up question I had. In other words, how little to none of the Fed's tightening measures have actually shown up in the forward indicators?
I would say outside of housing, effectively zero. When you look at modeling changes in Fed policy or even changes in long rates on earnings revisions or PMIs, it's a long and variable lead. Sometimes it's 16 months, sometimes it's 20 months. It's not 6, 7 months.
So I'm curious about this, guys, and this is kind of a question for all of you. One, do you think that the FOMC members understand that, and therefore their policy is largely performative and kind of fuzzy based on this idea of credibility? Or do you think that they don't quite understand this and they've lost confidence in their ability to forecast inflation?
I think it has more to do with the latter, by the way. I do think that there is an increasingly personal and political aspect to it. You've heard me talk about my concerns around Jerome Powell's legacy and how he thinks he's going to be perceived. But to me, the underlying feature is we were told this would be transitory. The definition of transitory was not well explained, right? I've had this debate very publicly with my partner, Harley Bassman. When I say transitory, I'm thinking 2 years, and apparently people heard 2 months, right? I don't think that's a reasonable interpretation of events. Again, I point back to the 45 to 47 episode, which was roughly 2 years in duration. We lack the ability to take that pain and to understand that we largely, unlike World War II, where it made it very easy to come together as a group and say, hey, we're all going to come together and recognize that there are costs associated with this, not to mention the loss of life component. This time it was largely inflicted by the leadership in terms of shutting down the economy and 2 weeks to flatten the curve. We now are basically dealing with the ramifications of that. Nobody wants to take ownership, right? Nobody wants to say, well, the reason why this inflation is occurring is because we shut down the economy, now we're reopening it, and there's all these disruptions associated with it. We spent too much money in a fiscal stimulus package. Nobody wants to take ownership of that, and so I think politically, I referred to this earlier today as well, I think it's very convenient for particularly the Democratic Party to say, this is for the Fed to solve, this is not our fault, they're going to deal with the problem that they created. And I think there's a very real risk, by the way, that post-midterm elections, that narrative changes quite significantly, potentially leading to a significant impingement of the perception of Fed independence.
I'll give a quick answer and pass to Jim. There's 2 Feds that have stopped giving guidance, FedEx and the Fed. And so I agree with Mike. It's the latter. I think they remove forward guidance so they don't put their feet in their mouth multiple times every month. Inflation volatility is the bigger concern, I think, than high or low. And if we're setting policy off of whether CPI beat or missed by 10 bips every month, I mean, geez, we're going to lose our minds.
Welcome to tomorrow morning.
Yeah. What's going on tomorrow? But the same thing's true. You hope they understand it. I think yes, but whether it's political issues or waiting until they see it to react to it, again, FedEx or companies are historically horrible at guiding the future. That's not just really an extrapolation of what happened last quarter. So, it's very common.
So you're the perfect person, Mike, because you can help us understand where we are in that cycle. How far are we? I mean, give me a sense of I don't think I actually asked you specifically. You said a recession is likely. How likely? Do you feel comfortable putting a number on that? And where are we in the cycle? And how far are we from when we can begin to see inflation start to come down and unemployment begin to rise?
So inflation, recession, I'd say the highest number I can give you without saying 100%, because I think FINRA would slap me on the wrist if I said that. But again, I say that off the three reasons historically, again, going back to the beginning of time, 50s, anytime we've had a Fed tightening cycle, a food and energy inflation spike above 5%, and banks tightening lending standards, all happening today, all happening before every recession. And those second two items, food and energy spike, inflation, and banks tightening lending standards, were not present in the 4 times the Fed raised rates and we didn't go into recession. So broad tightening cycles beget broad economic slowdowns. That's what we're, I think, in the middle of, or moving towards. The debate that we have mostly with institutional clients is not about are we heading into a downturn or a slowdown. I think everyone agrees with that, but it's the magnitude. And the work we've done on past periods where forward earnings estimates are falling, it's only actually happened 7 times since 1985, since that data exists. The playbook's the same, whether earnings fall 5% or 50%. The types of companies you want to own in this environment, because when we wake up every day or every week and say, well, did earnings estimates get better or worse this week? Did the economy get better or worse this week? As long as the answer keeps generally being worse, money's gravitating towards the same types of assets and moving away from the same types of assets.
And what are those types of assets?
So it's
what are the
typically
characteristics?
Companies with high cash flow profitability, high interest coverage. You and Jim were talking about companies with weak interest coverage or high interest coverage. So it's really unique right now. We're seeing 2 factors do well that typically go inverse. Companies with high interest coverage are crushing it, especially in the Russell 2000. I was actually looking up while you were talking. Straight line up. And over time, it's a straight line up. Really, Russell 2000 always has a lot of poor quality companies. But what's also doing well, because rates are going up, is stocks that are highly correlated to 10-year bond yields. So just, again, it's not as broad based as it would have been if the economy was getting better, and that's why yields were going up, carrying all cyclicals. But this year, they've both been outperforming. What I think is we're going to see, eventually yields will peak, and interest coverage is going to go like this, and yields will go like that.
Yeah.
But right now, they're both going up, so people are playing the slow down the economy and worrying about balance sheets, at the same time shorting treasuries effectively through equities.
Yeah, so I tend to think that's right, and unfortunately, historically, stocks that have been positively correlated with rates are also stocks that are historically correlated with growth, right?
Yes.
So, they're effectively gambling on a positive cyclical framework, which is matched, and I almost wonder if it's like the factor, systems have run amok, right? They're basically looking at the underlying environment in the same way that people would have relied on a risk parity to could protect their portfolios in bonds. They're reacting to the signal that's coming through from the rates component by buying the stocks that are the most cyclical, most sensitive to the higher rate phenomena, which has been historically associated with an accelerating economic cycle, even as it decelerates. Yep. It feels very perverse to me.
And what's driving it is in that ratio, it's really the growth companies getting crushed from higher rates, not like the cyclical value names that are in the numerator do better when rates go up. Right. This year, certainly not the case. Right. So that at least helps give some color.
If I was to add to that, the way I like to express it is the same thing here, is rising rates in and of themselves are neither bullish or bearish. It's why rates are rising. Now, if they're rising because Well, rising rates would usually correspond with more real nominal growth. Now, if it's the real part of growth that's driving them higher, that's a good thing, and the cyclicals go and everything else. If it is the inflation part that's driving them, it's not such a good thing. But it's been such a long time since we've seen inflation. I think a lot of people are having a hard time differentiating this, because early on this year when rates started up, a common refrain I heard from everybody was, this is good for the cyclical stocks, right? Rising rates. And it's like, well, it depends on why rates are going up. And it's been 40 years since we've had to delineate the reason that rates were going up. It was almost always real growth. And that's what people have been struggling to get their head around.
I think that's a really important nuance to this bear market in equities. The first 6 months of this was a bear market in bonds that equities became the victim of. That's still going on. In the middle of the year, earnings estimates did peak and are now accelerating to the downside. So it's become kind of a combination of a interest rate bear market, duration bear market on top of an earnings bear market, or the typical bear market we all know. So yeah, to Jim's point, there are not many periods in time, and it's only when the Fed's hiking where growth is slowing and yields are still going up. And this is, like I said earlier, since the 70s, this is the third longest period in history, 21 months now of that.
And I would actually highlight that there was another factor to that, right? And this was alluded to in earlier conversations, but it's the component. There was actually a bear market that started in the speculative stocks February of 2021, right? So effectively, we ran out of money, or we finally produced enough assets to fill the need that was demonstrated for that speculative component. Those sectors of the market began to underperform significantly. And I would by and large argue that people have become complacent in that, the story is all one of valuation or craziness, et cetera. They feel very poorly prepared for an actual recession at this point. At least that's the way I'm seeing the behavior in the market.
Yeah, it's been a long time, and what I speak to, again, it's all institutional investors, and what we tend to find, institutional investors are largely stock pickers. But they look at the market like they're a stock picker. So they say, oh, well, the valuation's here and the earnings number's here. I'm going to buy when we hit 3,200. That's not why markets bottom. Markets are driven by macro. Stocks are driven by micro individually. So it's really, the question is, when are we going to bottom? It's not how bearish people get, not how cheap the market gets, it's not how big the drawdown is. And again, this drawdown is largely bond driven, not earnings driven. That's all ahead of us. And so we believe there's a ways to go here. And all these historical comps are going to be garbage in, garbage out.
So just to bring it back to this conversation of a Fed pivot, normally how long before the market bottoms does the Fed usually pivot ahead of a recession?
So
normally, in other words, so this time,
I got your
presumably the
question.
pivot's going to come, okay, got it.
So when you're not going into recession, those 4 times, 1966, 85, 95, and 2019, when you're not going into recession, of course you don't know until after, but how will you know? Look at the housing starts data. In those 4 periods, the Fed pivoted, a month later, housing starts, boom, picked up. We had a good economy, so the end of Fed pivoting, which was the only issue really, or tightening biggest issue in 2018, housing bottomed in Jan 19. NHB index, building confidence, V-shaped recovery. So that's not what we're looking for. And that's how in the summer, when the market was ripping, we saw the housing data getting worse and worse. We're like, no, it doesn't fit into history. If we're going into recession, when the Fed pivots historically, unless we're actually already in the recession, which happened in 1974, there was no pivot rally. Every other time, you will get a rally in equities, and the rally in equities will be a function of when the Fed pivots, and how far away you are from earnings estimates falling and claims rising. So in June 06, the Fed stopped. We had a 15-month rally left in equities. It was narrow, industrials, materials, and energy. But claims were flat as a pancake. Earnings estimates kept going up through 07, and then Q4 07, market peaked, claims bottomed, earnings estimates peaked. In 2000, the Fed stopped in May. We had a 3-month rally. It ended in October of 2000. Claims started going up, earnings estimates peaked. The same pattern that goes throughout history. So the issue today is that while claims are not going like this yet, earnings estimates are coming down. So I think when we do get the Fed pivot, yes, of course, because there's so much focus on it today. There's so much transparency today. People are trying to get ahead of it every day. Yes, there will be some kind of rally, but I think it's going to be really short-lived, something like what we saw in 2000, a couple of months maybe. And again, it really matters when they stop. When do they pivot in the business cycle? You can't just look at typical times. When the Fed pivots, the market goes up X. Again, that's looking across different regimes. It really does matter when the Fed started and when they stop in terms of, in the context of the economy, and telling you how.
When they
how much the
started
market can.
tightening and when they stopped tightening, or when they started loosening and when they stopped loosening?
Both, but just a real simple example. If you looked at a table of how does the market do when the Fed's raising rates, and if you look back the last 8 tightening cycles, market on average goes up. Why? Because in 6 of the last 8 tightening cycles, including this one, the Fed started raising rates at the beginning of an actually upturn in the economy. 2016 was the beginning of a 2-year recovery. 1994, year of recovery. 1984. Things were improving. The Fed started raising rates here literally past the top of the cycle. So that was, they were raising after the bull market, and that's why that just doesn't fit into history.
So looking for a Fed pivot to guide your decision about when to enter is actually not the correct framework.
No, you got to look at same thing with CPI. There's been periods in the past where the market has bottomed when CPI has peaked, but that's not full. It's not giving you all the information. Because what you'll notice in those periods when that's happened, 74, 81, 91, at the same time, the economy massively turned up.
So, yeah, I was going to take what you said and go on the other side, too. When do rates peak? And let me start with the 2-year note. If you look at the last 6 cycles, going back to the early 80s, and you look at what is known as the terminal rate, where is the rate where the Fed stops raising rates? Every one of those cycles, and further, you look at, say, the Fed fund futures or some forward measure of where the market thinks the Fed's going to stop. The 2-year rate usually goes above that rate. So to put that in today's terms, the expectations are that the Fed will stop at 4.5, and the terminal rate has gotten as high as the Fed fund futures has projected the terminal rate as high as 4.73. On average, you should go above 473 in the 2-year note before this is over with. Sometimes as much as a full percent. I mean, it doesn't have to be a full percent, but in every cycle you will go above that rate. So we're at 430 on the 2-year note right now. We've still got some ways to go if that historical analogy holds. On the long end of the curve, there's a problem here because the yield curve is inverted. The 2-year, 10-year yield curve is inverted. So you're trading at about 35, 40 basis points lower yield on the 10-year than you are in the 2-year. The most extreme it's been in the last 40 years has been minus 58. So we're not that far away from that. So unless you want to make the argument that the yield curve is going to go to minus 100, if the 2-year note's going to keep going up, I think it's going to keep dragging the 10-year note higher as well, too, and that relative curve cycle will stay. So as you said, this has been about a bear market in rising rates, a bear market in bonds. When do we end this bear market in bonds? Well, the simple answer is when the Fed stops, but the more nuanced answer is probably above that terminal rate. And we've not hit that terminal rate. We've not seen those rates yet reach it. So we've got a ways to go if that historical example holds.
So I want to try and combine 2 questions into one here. And the first question is, do bonds at these prices represent a fairly good investment for a buy and hold investor? And the second question that kind of goes into that is, can the Fed, how high can the Fed really raise interest rates if that has such a negative long-term financing impact on the US government? And so this brings up questions of stuff like yield curve control. In other words, is it inevitable that the Fed is going to have to step into the breach to monetize government deficits long term?
Can I take the second part first?
Yeah, take it.
$30 trillion of debt outstanding, and net, the government will refinance about 1.5 of that a year. So, in a year, $29 or $28.5 billion of the debt that they have has got a fixed rate, and that's not going to change. So if the answer is, if rates go up, does that increase the interest rate cost to the government, and does that put a drag on the government's budget? Yes, in 5 years. Yes, maybe in 3 or 4 years. No in the next year or two. And I think that that's motivating the Fed too, that they could take rates as high as they need to take them in late 22, 23, maybe in the early 24, and not have to worry about the refinancing implications of it. You start getting out 25, 26 with higher rates, then that becomes an issue. Their thinking is higher, more aggressive now into 23, early 24, cut rates then after that, and then that this idea that we're going to have this interest cost balloon won't be as big a deal. Now, a lot of it will go into short-term debt, like T-bill yields will go up, but then they'll come right back down when they cut rates.
So just very quickly, I'm sorry, because that doesn't match my understanding of what the average weighted duration of the U.S. federal deficit debt is. Isn't it more like 7 years?
It is, but a lot of the debt is still less than 1 year. And so the assumption there is, yes, in the next year, everything that's a T-bill gets refinanced at a higher rate. Then they cut rates, and it all gets refinanced at a lower rate. But if you're talking about fixing rates at a permanently higher level that they have to pay for years on end, that will take a longer time period to get the average interest rate much higher to see a drag on the budget of the government.
So there's two components to that I guess I would push back on. One is interest on excess reserves, right? So we still have a fantastic amount of excess reserves that effectively have to receive the same level of interest expense as the Fed funds.
We're already at a loss on that now. The Fed is already paying out more in interest on excess reserve than they're receiving an income on their system open market portfolio. And they're about to raise rates another 75 basis points, so it's going to get worse.
So, but that definitely the way I look at that has to be factored into the interest expense of the U.S. government. We have to consolidate those accounts.
Yeah, I mean, the Fed remits its
remits its gains.
Yes,
but it has to also remit losses.
It doesn't have to remit losses because the Fed can always print money to cover their losses. They don't have to if they don't want to. But you're right, they've probably been remitting, I think, somewhere around $60 to $80 billion back to the Treasury in January every year. That'll go to zero this year or in early 23. But they don't have to remit a loss back to the Treasury because the Fed doesn't have to abide by mark-to-market accounting. So we could look at it as market people and say, they're at a loss, but they don't have to look at it that way.
No, I'm actually referring to something different, right? So the interest expense on excess reserves that they have to pay into the banking system in order to maintain a corridor system, right, is an actual cash outlay that has to come through the Treasury.
Well, it comes through the Treasury in the form of the interest that they receive on their portfolio.
Well, no, because the Fed is also paying to banks. Right.
Well, that's where they get the money to pay to the banks. They own $9 trillion of treasuries that bring them into cash flow, and they turn around and remit that out as interest on reserves.
But if the interest on the bonds don't rise, and you increase on $4 trillion, $6 trillion worth of excess reserves, interest rates by 400 basis points, that's $240 billion that I now have to pay out into the banking system while I've not changed my income receipt at all.
Right, yeah, that's why I said that they're at a loss now, but they just hit that loss level now. They're not, the loss at this moment that the Fed is paying out more in interest on reserves than they're receiving on their portfolio, but it's very small. But they're going to raise rates again, and they're going to raise rates again. So it's not going to be quite, I don't think it's quite that much at $240 billion, but it is a big number.
Can I interject to clarify something here? So, Mike, what you're talking about, just so I'm clear here, what you're saying is that in the intermediate term, before the government has to refinance some of its longer duration debt, the Fed is stuck in this paradigm where it has to, as rates go up, it has to increase the amount of payments that go out to the banking system in order to maintain the corridor system. But that's the opposite of what we're talking about with respect to the government paying more, right?
Right.
Well, that money comes from the government.
Right, I understand. I mean, institutionally speaking, that the Fed would be, but your point is it just compounds the problem of whether it's Peter or Paul, it's coming.
Somebody's paying.
Somebody's paying.
But as long as it's variable, it will come right back down when they cut rates. But the bigger concern is if they roll over enough 5-year, 10-year, 30-year debt at higher interest rates and have 4 or 5 coupons that they have to pay for a decade or more, then that becomes a longer-term burden on the government. That will take more time.
I think one of the things that concerns me most is if I look at this last round of job owning and basically saying, we're really serious, we're going to raise, it actually, unlike prior rounds, has not shown up in lower inflation break-evens. This is actually now pushing inflation break-evens higher, right? And this is one of the theories that I have around this, which is that by failing to allow the economy to adjust, you and I are actually having this conversation today, by effectively trying to crush demand instead of allowing the economy to retool itself and reposition itself, responding to this and radically changing the structure that basically causes everybody to turn around and say, hey, I'm going to wait and try to figure stuff out. I am not going to build any new houses despite the fact that there is a generalized and recognized housing shortage. I'm not going to, make significant investments in oil and gas because the cost of capital is so high. I'm not going to make significant investments in infrastructure because I'm going to wait for the magical 2 years from now, the cost of financing are going to go down.
Right.
Right. By delaying all those things, aren't we actually locking in inflationary conditions?
I think we definitely could be. But to your first point, when you look at the Treasury inflation protected securities, the TIPS market, color me skeptical about that market. Before the pandemic, the Fed owned 8% of that market. They now own about 27% of that market. They have been the largest buyer of it since the pandemic. In fact, the amount of TIPS securities outstanding has barely increased versus 2020 if you exclude the Fed's purchases. What I'm trying to say is they're the butcher that put not only their thumb on the scale, they put their whole hand on the scale, and they've kind of screwed that market up. That's the way that I look at it. And so whenever I look at what the real rate is on the TIPS break-evens, or what I look at the real rate on TIPS yields or the TIPS break-evens rates, I then look at historically and find out that the predictive ability of that market is 0. It really, it's an interesting number to look at, but it doesn't mean that that's what's going to happen.
So I definitely agree with that I don't think it's going to happen, right? But it is ultimately a market in which you receive rewards for making bets that reward you for being right?
Right.
So it's going to be the closest thing we have. It also, interestingly enough, matches almost all of the surveys that we have in terms of consumer expectations.
So let me throw a question at you then. In a TIPS security, you get the inflation rate. It accretes to you. That is roughly 8% right now. And the real yield is about 1.6 on a 10-year. That's a 9.6% yield on something with no credit risk. So why does any other investment exist in the world if I can get 9.6% from the government without any investment risk? That is a distorting market that, I don't have an answer to you.
So the quick answer to that is just very quickly, I was actually outside dealing with my kids who are struggling to fill out the paperwork to buy I-bonds on a personal basis where you're limited to $10,000, which of course I've given to them, right? So that they can lock in the 9% sort of yield, right? They're now talking about expanding that to 30,000, but within the scheme of most, financial planning components, that's meaningless, right? So it's effectively a protected market. Now, can I go into the market and buy TIPS? Sure, in terms of the inflation protected securities. But to your point, that's a relatively illiquid market with no guarantee of my compensation. I'm ultimately subject to the volatility around an inflation print over a short period of time.
Sure, inflation could come down.
Which then means I need to go out and hedge things like I need to hedge out oil as the largest component of that, et cetera. So I would suggest that the higher the volatility of the underlying components, things like oil, et cetera, the harder that is to lock in a quote unquote arbitrage position.
Right. And every quant I've talked to when it comes to the TIPS market, whenever they model what are the factors that move the TIPS market, it is usually the VIX, the yield curve, some other measures of volatility, the price of oil or gasoline. And other than the price of oil or gasoline, the rest of those are not inflation measures. Yeah. But then we put a bunch of non-inflation measures in there, and then we say that this is the market's compensation for inflation. So other than it being an emotional reaction to crude oil prices or gasoline prices, kind of the same thing, that's why it has, I think, a zero correlation to reality, because what it moves on is stuff that isn't inflation.
Well, I'm not entirely sure I would agree that it has a zero correlation, right? It is not a great
Historically.
predictor.
Yeah.
But that also, in the time period in which we've dealt with TIPS,
Yes.
we really haven't had significant inflation volatility of any meaningful component.
That's true. The first tip came out in the late 90s, so
Right,
we don't have
1998.
one from the 70s. We don't know what it would have been if they
Yeah.
existed in the 70s.
Yeah, I do think that this is one of these interesting things where we can look at that and we can dismiss it, but the obvious bet, if we have strongly deviant views from it, is to actually express them in that market. That can be
Yeah.
done without the hedging components. We just can't lock in non-arbitrage conditions. We can express a bet there. And I do think it's really interesting that nobody really seems to want to go do that.
Yeah, I find it very interesting myself too.
So let's talk about, you guys have been talking about inflation all this time. Let's talk about this in more concrete terms. What the Fed is doing, what policymakers are doing, with the exception of the Biden administration and then the Strategic Petroleum Reserve, is largely deflationary. The question is, structurally speaking, so let's actually frame this a second. The last 30 years,
I'm sorry, I wanted to interrupt on that, because we were both going, wait a second, why are you saying?
Supply or demand, though.
Yeah.
It's deflationary and
what?
demand.
So go ahead. Well, I was saying that the SPR release is deflationary. What did I say?
No,
You were right. I think Mike, to bring back to Mike's earlier point, is that raising rates
but it
is not
was-
a good way to fix a supply problem. So
Right.
longer term.
Right. Sorry.
we're
What I was
thinking
really,
about the
sorry. What I was trying to say was that the SPR actually alleviates some of the stress on the economy that occurs as a result of the rising interest rate environment.
Yeah.
All these different rates, all these different prices, they all get all confused in my head. Go ahead.
well, we're definitely trying to suppress gasoline prices, right? And
Yes,
the
I
release
wasn't-
of the
I wasn't-
SPR into that, but I'm not sure that I would agree that it's designed to alleviate the rising interest rate component.
No, it's not. No, that's not. I shouldn't have even said that. No, I confused everyone. No, that's not at all. What I was basically just saying, let me rephrase it and simply say that what policymakers are doing by trying to induce a recession and get inflation down is deflationary.
Yes.
The last 30 years or so, there's been structural deflationary forces driven in large part, not only, but in large part due to many of the efficiency gains that have come with globalization. The question I basically have is that period dead? Because so much is now changed, and geopolitics is front and center there. The geopolitical order upon which the neoliberal economic order that enabled all those efficiency gains to occur is changing, and how to handicap that at an elemental level is a whole nother question that I wanted to ask you guys. But are we now in a new era where we're going from structural deflationary forces to a period where, when it comes to companies managing their supply chains, they're going to look more for less towards efficiency, more towards resiliency and redundancy? And are we going to be seeing longer-term structural inflation? And how does that fit with what you guys were talking about in terms of variable inflation? So inflation in different parts of the economies, maybe as part of that reshoring or reconfiguring supply chains occurs.
So there's a lot of questions.
Yeah, I hate doing that. I got thrown off with the SPR release.
Oh, good.
Been so good at not jumbling questions on this panel.
You know, I think as Jim, articulated really well, we've had 30, 40 years of just massive tailwinds to macro, whether it's trade agreements and globalization, technology, productivity improvements, cheap labor, cheap money, cheap goods.
Yep.
Right?
Yep, cheap energy.
Cheap energy. So maybe, we've probably hit the max benefit of that. Will we go all the way back the other way? I don't think so, because of some of the debt issues we have. I think we've got a kind of a ceiling on how long that could last. But I think the answer is somewhere in the middle, and it kind of also makes me think about what Mike and Jim were talking about. Where's the growth going to come from next?
Yeah.
And I kind of think about, okay, the 80s, there's no such thing as normal. So let's throw that out. The 80s and the 90s the growth came from the US consumer and all those benefits. But it was really US consumer leveraging up, finding their credit cards, their mortgages, and everything else. And that got exacerbated in 2000s as the rest of the world joined the party. The euro was created, China joined the WTO, and so massive debt bubble popped on the private side. And then we've had, following that, right, 15 years or so of balance sheet bubbles, zero interest rates. And all the while, the governments around the world have cleaned up all of these messes. So we've got massive debt to GDP issues as well. So who's, if it's not the US consumer creating all that massive spending booms in the 2000s, and 80s and 90s, if it's not more QE, more balance sheet expansion, and if governments are kind of tapped out, where is that growth going to come from? It's not going to come from India. It's not going to come from China again. I don't think it's going to come from the US consumer. I mean, we've got productivity.
Isn't it going to be monetized?
That's what we've already had.
I mean, we're just going to have more of it. In other words, isn't the path here actually, especially if a lot of the operative models are kind of broken, which is what I think we're all talking about here, whether it's markets, pricing, the consumer, doesn't that kind of imply that whatever entities in the economy or in the political economy have power are going to be the ones that are actually going to step in and sort of, what I'm thinking is more government spending, more fiscal programs, energy policies, military spending. Again, we could be on the verge of a World War III type of a world. I mean, the reality is that this is where things are going if something doesn't stop it. It doesn't seem to me that the paradigm right now, and now we're kind of moving into a conversation about war, but the paradigm right now in Eastern Europe, Russia, Ukraine, NATO, as events currently are sort of moving, is escalatory. Something needs to intervene to change that dynamic. And I'm somewhat...
I would argue what you're describing is what I've called the post-pandemic economy. Hopefully it is post-pandemic and we're not ongoing pandemic economy at this point.
Right, because you're not wearing a mask and I'm not wearing a mask.
Yeah, exactly.
So.
We don't go back to that. But in that, every pandemic has shown throughout history that it takes a trend and it speeds it up. And so like when I said to you earlier that, we're in a sci-fi movie and we've jumped ahead to 2045, we're not doing anything we weren't going to do. We're just doing it much faster. And so I think the thing I believe we have to come to grips with is that the era of worrying and fretting about deflation ended in 2020. I actually think it ended in 2009, but let's just go with 2020. And now we're into a period of inflation. Now, I know when I say inflation, I know you mentioned this in the last panel with Chanos, when I say inflation, everybody goes to Zimbabwe or 1980 or the Weimar Republic. And no, it's like a 3.5%, 4% inflationary world, not a 1% to 2% inflationary world. And that means that rates at 4% are neutral. And the market's choking on 4%, and they've just reached a neutral rate. Now, why do I think that we've got a post-pandemic period of more inflation? It's the end of cheap labor. Labor is having a bigger say at the table in terms of negotiations. Look at the rail strike, and I thought it was interesting, Mike Green, you pointed out correctly that the freight strike, the first thing they agreed on, just like with the West Coast longshoremen, is the price increase. That's done. That's done. They're going to get a 24% price increase, wage increase.
Over a 5-year period.
Over a 5-year period, 14% immediately, and then the rest comes over the next 4 years. But they're arguing over work rules. And that is a tell to me that labor has gotten a bigger say at the table. Usually it was here's a bunch of money, now go back to work. And they gave you a bunch of money and they said, hold on a minute, we want more. So the cheap labor might be coming to an end. And evidence of that in the data is wage inflation is running at around 5%. It has been for about almost a year and a half now. If you get a 5% wage increase, and that's the whole economy, it's going to be hard to have a 2% inflation rate with a 5% wage increase. 3 real is way too much historically. Maybe 0.5% might make sense, and 5 might be a bit elevated, and it might come down. Cheap goods, in a just-in-time inventory world, China all of a sudden looks like a really unreliable supplier. Between the supply chain problems, between the political problems that they've got, and with all of the fights we're having with reshoring, friendshoring, the semiconductor fight, they look like they're a real problem. Cheap energy. I'll channel my inner Zoltan Posner here. And he pointed out that $27 billion of cheap gas goes to Europe pre-Ukraine war, and that is used to create $2 trillion of cheap goods. Every manufacturing process is cheap energy is the driving force. It's not labor. They don't have cheap energy anymore. Witness today, the UK has pointed out that industrial production has fallen 23%. That is a depressionary decline. Why? Because look at the price of gas, in natural gas in Europe. So if you've got all of that, that is going to push inflation up. Now, you still have a couple of forces that are working to keep it down. One being demographics is still positive for inflation. The other one being technology and making more efficiencies is still positive for inflation. But I don't think those two, I know this is where we disagree, I don't think those two can offset the loss of cheap labor, cheap goods, and cheap energy. And that's why I think that we settle out at a much higher inflation rate. And the last thought for you on this. This is the conversation the Fed needs to have. Jay, give a speech. Tell me that you think inflation is persistent at 3%. If you say that, raising rates 75 every meeting to try and get to 4% as fast as you can makes a little bit of sense to me. If you still believe that this is a one-time post-pandemic surge of inflation and it's going to dissipate in 18 to 24 months back to 2%, you're way overdoing it. Give that speech and let us debate it. Now, the problem, I believe, is within the Fed, they can't agree. Jay Powell, maybe Chris Waller, a Fed governor, maybe Jim Bullard, St. Louis Fed, are probably on the idea that this is a persistent inflation problem. Lael Brainerd, the vice chairman, Charlie Evans, the Chicago Fed president, maybe some of the staff at the Fed are not. And since they can't agree, what is every speech we get from the Fed? We're going to raise rates at the next meeting by this much. We're not going to pivot. They can't go beyond 30 to 45 days because that's about the only thing they can agree on at this point. They can't tell us what is the big picture on inflation. And also, as you point out, Mike Green, talking about the big picture also is a bit of a mea culpa, what you did last year as well, too, and they don't want to go there as well.
Looks like you ran out the clock here, Jim.
Okay.
No, come on. Is that really the end? Are we out?
I believe it is. I mean, I know that, but I'm happy to keep going.
I'd love to keep going.
Let's keep going, actually. Did either of you want to jump in on what Jim was saying?
So the biggest component of what Jim is saying, first of all, I completely agree that part of the problem is that we actually don't know why the Fed is doing what it's doing. Like, we don't know the model anymore that they're operating under. They've moved from very transparent, here's all the research, here's what we're seeing, to an environment in which they are increasingly, because I told you so, right? I mean, this is like parents who have lost their, I've used this analogy often, right? As a father, the number of times I had to say to my kids, guys, get it under control. Mom's about to lose it, and once she loses it, I can't help you anymore. Right? I honestly think that is what has happened, is that Powell listened to his staff who said this is going to be transitory. He is one of the most intensely political creatures I've ever seen in Washington. And he basically said, I'm embarrassed. At this point, I'm losing my temper. Screw it, we're going Volcker. Right? The fact that he invoked that dynamic, that he's trying to tell us how tough he is, how resolute he is, to me is indicative that this has nothing to do with the underlying economics. It's functionally mom basically has lost it, said you're grounded for life, you can never leave your room ever again, and by the way, while you're in your room, I expect you to clean all the house, right?
No more allowance.
Just, no more allowance. Like, it's just like we've lost it completely, right? I honestly think that is what is underway right now.
But he did catch a lot of criticism from institutionalists like Mohamed El-Arian and Larry Summers back in the summer and fall of 2021. And your view is that got under his skin.
I think actually what got under his skin much more is the whispers at cocktail parties in Washington, D.C. saying, look, there's Powell, this is all his fault.
Let's go back to the thing I was saying before, which was not well articulated, about the government stepping in, monetization. What is your view on that, Mike?
Well, look, I think that's actually, for me, one of the most frustrating aspects of this is that everybody wanted to step in from an institutional framework and criticize the Fed when they were being interventionist and activist in terms of lowering interest rates and providing support. And now all of a sudden, as they're being activists and interventionists on the other side, it's like, oh, thank goodness.
Well, it's not just because people love to
doing
criticize because they're never in the arena.
I actually think the irony is that I encounter far more people who are like, well, the Fed has to do this, right? And I point people to the 45 to 47 episode and say they did absolutely nothing. They let the system rebalance itself. What they're doing now is they're using lagging indicators to interject even more volatility into the system. That's why I was raising the emphasis on Harley's outcry. Like, this is not possible. We've got 150% volatility in the rates markets with rates somewhere around 4%. Like, the implications around that are functionally throw your hands up and say, I have absolutely no idea how to finance anything anymore. Right? That's an extraordinary statement in an economy that needs investment.
To underscore something Mike just said, if I go back to my theory that the end of cheap labor, cheap goods, cheap energy, that's not forever. What that is a call that the economy needs to be restructured. That means things have to, there is cheap energy out there. It's just no longer coming from a pipeline from Russia. There's other places you can get it. What would be nice is to get some financing to change it, but what's the Fed doing? Jacking financing rates every 30 days. So they're working against trying to do that. There is other forms of cheap labor that we could possibly do, maybe even a restructuring of the labor market, but we keep jacking rates.
But again, doesn't that imply that they're going to reverse, and they're going to reverse hard at some point, and we're going to have something like yield curve control? We're going to have permanent subsidized government financing?
Sure, they're going to reverse, and they're going to reverse hard at some point, but at what pain point does that come? Everybody wants to think it comes at a painless pain point. That's the way I perceive the pivot talk, is that they're going to stop some Tuesday and then it's just going to go up and I'm going to say this nightmare's over. But it's going to be coming at an extreme pain point.
Well, it seems to me that what you guys are describing is an economic contraction of such magnitude potentially that would make the opportunity, the excuse for the government to act and to act big on the fiscal side even easier. Right? Like the conditions.
I think that's exactly correct. But I mean, this goes to what we've just seen from the Bank of England, right? The Bank of England is now faced with industrial production falling 22, I think it's 22 or 23%.
Yeah.
Right? And they're raising rates. That's the most insane thing I've ever heard. Why are they being forced to do this? Because the Fed is raising rates and creating conditions that we historically would associate with an EM crisis. And we're causing it in our allies.
Here's kind of a circular reference, it's a bit perverse. As everyone is now, the developed economies have now raised rates joining the Fed to support their currencies. It kind of gives the Fed a little more room to keep hiking without getting the same as big of a swing up in the dollar.
It also turns around and becomes a groupthink dynamic of, well, this is what we all should be doing, right?
Yeah.
So I'm getting the signal that I need to wrap it up. So I want to ask one last question, and it was my point about the war, because this is a really big deal, and there's really none of us here are four-star generals, or none of us work in
Mike actually does. It's
I played Call of Duty. Does that count?
We all played Call of Duty, and so there's no really easy way to handicap it. I'm just curious how you guys think about it and factor that into your work, or do you just ignore it and just pray for the best?
Well, so we're very cycle driven. So hopefully I'll never get labeled a perma bull or perma bear. Last year we were extremely bullish for a lot of the same reasons we're extremely bearish today, just flipping on its head. So I'm, at least for what I do and the way the kind of research and insights we provide, it's more cycle driven. So yeah, the secular stuff, what's going to happen over the next 10, 15 years is going to matter. But at least at the end of the day, I can still wake up and say, listen, at some point there'll be a time to buy stocks and they're going to rip and the economy is going to pick back up. It's not today. It's not anytime soon. But Japan's stock market, which went down 70% over 20 years, still had 4, 5, 50% rallies. So, not that I'm not concerned about, but when you talk about the war, what's concerning cyclically now is that when growth slows, bad things happen. And right now, the bad things we're seeing are really a result of high interest rates. It's going to get a lot worse if and as growth slows further. And we've all worked at a company or been somewhere, where, listen, if the pie's growing, everyone's happy, even if they're not gaining the same share of the pie. But when that pie stops growing, and we're now fighting to maintain market share, because that's the only thing we can do to survive, that's what the world's facing right now, which is, again, why, in the last 20 years, 15 years, it was all competitive devaluation, because it was free to have low rates, you didn't have any inflation. Now it's probably the opposite. So I think longer term, still very bullish on the U.S. dollar.
And I would also just add to that. I mean, historically, the pushback that you would see against this type of policy is the U.S. dollar is rising. That's making the industrial base uncompetitive. We won't be able to export to the rest of the world. The U.S. is functionally deindustrialized to the point that we ship agriculture and energy abroad, right? And so we have become a Saudi Arabia type component. We're experiencing a component of Dutch disease that means that reshoring that we're trying to accomplish is likely not to happen. Right? I mean, this is absurd. I honestly think this is the most absurd policy I've ever seen conducted. And the weird thing for me is watching people cheer it.
And Jim, how about you? Any final words?
Yeah, I think that one of the big drivers for the last 40 years was globalization. So if I just look at the war in a general sense, it is basically dividing up the world. We're dividing up the largest energy producer, if you add in all energy, I was going to say the Soviet Union, but let's call it the Soviet Union, and that they're going to be at odds with the West, and they've got a spigot that they can play with to make the West's life uncomfortable. China might join that axis. Saudi Arabia might join that axis. This doesn't sound like a world of massive deglobalization or globalization anymore. It sounds like a world that we're heading towards in deglobalization. And if we are heading in a world towards deglobalization, it is going to be a big reversal of a lot of the positive tailwinds that we've had over the last 30 or 40 years.
If we don't have a booming consumer leveraging up, or governments that can leverage up, or central banks that can keep rates at zero and keep pushing their balance sheets higher, we're not going to get to that escape velocity, strong growth where everyone's happy and the pie is growing. So that could accelerate what basically Jim's talking about.
Yeah.
And I'm going to toss on one more dark component of it, which is when we talk about the dynamics of globalization, really what globalization is about is enforcing the economics law of one price, right? Something should be the same price here as it is elsewhere. Cheap labor in China should be exploited in the United States, providing an equalization component. I'm not sure it's quite the deflationary force that Jim and others seem to think it is because of that dynamic. It raised the purchasing power of 1.4 billion people. We're now actually watching a condition under which we're talking about deglobalizing. And in order for that to be the case, we have to break apart these components, and we have to make the Chinese unaware that they're paying a higher price or that they're being penalized relative to the rest of the world. The lines of communication are fracturing. We're entering into a new Cold War where basically the Chinese increasingly don't know what's happening here, and we increasingly don't know what's going on there. And those are the conditions under which wars happen.
Yep. So, again, ending on Mike always ends us on a positive note.
I try to.
Actually, you ended on a positive note on your last appearance on the
I really
podcast.
do actually believe,
did.
exactly as Jim said,
Yeah.
this is a temporary phenomenon. We're not going to deglobalize. It can't happen.
Yeah. All right. Thank you.